Welcome, dear students, to the massive open online course on money and financial markets. We are going to analyze securities, and this is the second module on security analysis. The objective of this module is to recognize the concept of return or yield and understand its various types, and after that we would like to understand the risk-return trade-off and try to analyze the capital asset pricing model. In short, it is called CAPM. The terms rate of return and yield are mostly used interchangeably, and also it is used interchangeably in this module, and we will follow the same. Return is the amount or rate of produce, proceeds, gains and profit which accrues to an economic agent from an undertaking or enterprise or real or financial investment. It is basically a reward for and a motivating force behind investment, and the objective of it is basically always to usually maximize return. Return has two components. The first one, we call it periodic cash or income receipts, and this is mainly in terms of either interest or dividend. And then we also have the concept of a capital gain or capital loss. It basically implies appreciation or depreciation in the price or the value of the asset. The capital gain or loss is the difference between the purchase price of the asset and the price at which it can be bought or is sold. The total return on an investment can be defined as income plus minus price or appreciation or depreciation. Next, we come to a very important concept. This is called the internal rate of return, IRR, and there is another concept which is also called the yield to maturity or YTM. Now, what is IRR? IRR or the average IRR is the rate of discount which makes the present value of all revenues or cash flows from the investment equal to the total cost of that investment. This is also sometimes called yield rate. The internal rate of return IRR and the yield to maturity YTM, they are usually measuring different things, although their calculations are very similar. Who uses IRR? It is the corporations who use IRR to evaluate the financial outcomes of the projects or investments the organizations are considering. Now, when the IRR meets or exceeds a corporation's cost of capital, the organization often decides to do that project. The corporate finance departments decides to recommend or reject a project if the IRR exceeds the cost of the capital, cash or other assets needed to fund the project. The senior management will then decide whether to agree to the project if the estimated results meet or exceed their strategic IRR financial objectives. Should the IRR estimate be higher than the cost of the needed capital, the senior executives may still reject the project if the IRR falls short of their financial objectives. So, one thing we find here is that IRR totally depends on the corporations, okay, and that is why we say that IRR and YTM basically measures different things, though their calculations are similar. Now, let us look at YTM, the yield to maturity. It is the individuals and the businesses which uses the yield to maturity to estimate the value of different bond investments. Yield to maturity results that meet your investment goals are attractive bond investments. We next come to the concept of holding period yield. What is holding period yield? The total return that is earned on an investment or portfolio of multiple investments are basically measured by the holding period yield, and it is also sometimes called the holding period return. This also represents both the capital appreciation and also any income earned over the period of time the investment was held as a percentage of the initial value invested. We can also report the holding period yield as an annualized rate of return, which is the best measure of an investment's profitability over time. Comparing the annualized holding period yields of different investments or asset classes allows the investors to make informed decisions about the perfect place or the best place where they can invest or place their money. After analyzing these various types of returns, we now look at the type of yields that are there. The first and the most important one is called the basic yield. It is basically the lowest yield that is actually attained in the market by various high grade bonds of a given maturity and class. And the distinguishing feature of the basic yield is that it is on the highest quality bonds. That's it. What is current yield? In case of a bond, current yield is the ratio of the stated coupon or interest per year to the current market price of the bond. It does not take into account the return to be realized by the investor because of the appreciation or the depreciation in the value of the bond. It is also known as the market yield. We next come to the concept of the yield to maturity. The yield to maturity represents the expected annual rate of return earned on a bond under the assumption that the debt security is held until it matures or until its maturity. So, from the perspective of a bond investor, the yield to maturity or YTM is the anticipated total return received if the bond is held to its maturity date and all coupon payments are made on time and then reinvested at the same rate of interest. The yield to maturity can be defined or can be represented as a formula as annual interest plus minus average annual appreciation or depreciation divided by redemption or face value. We then come to the concept of dividend yield. Dividend yield is the ratio of per share expected or prospective dividends gross of tax to the current market price of the share. Earnings yield is the ratio of expected earnings per share of the firm to the current market price of the share. And lastly, we would like to talk about the required rate of return. The required rate of return is the minimum return an investor will accept for owning a company's stock to compensate them for a given level of risk. To accurately calculate the required rate of return and improve its utility, the investor must also consider his or her cost of capital, the return available from other competing investments, and also from inflation. The required rate of return is a subjective minimum rate of return. This means, suppose that there is a retired personnel, he will have a lower risk tolerance and therefore he is going to accept a smaller return than an investor who have recently graduated college and obviously has a higher risk appetite. So we can say that the concept of the required rate of return plays an important role in the valuation of assets and in both financial and real investment decisions. The required rate of return has two components. First, we have the risk-free return. It is the reward or price which needs to be paid to the saver to induce him to forego present consumption in favor of future consumption plus a premium for expected inflation. Strictly speaking, the real rate of return is defined in the context of the absence of the uncertainty and the absence of inflation. But since inflation is usually present in the real world, the nominal risk-free rate must contain an inflation premium. Thus, the first component of the required rate of return is the risk-free rate of return, which is equal to the real rate of return plus the inflation premium. The second component of the RRR is the risk premium. The rational risk-averse investors purchasing an asset expect to be compensated for the risk. The premium for risk must reflect all the uncertainty involved in investing in that security. Thus, as a formula, the required rate of return can be expressed as RRR is equal to pure time value of money plus inflation premium plus risk premium, or RRR is equal to risk-free rate of return plus risk premium. Next, we talk about the risk-return trade-off. The objective of maximizing return can be pursued only at the cost of incurring higher risk. And the financial market offers a huge array of assets from very safe to very risky class. We are going to here show a figure which shows the risk-return trade-off. In the figure, we see that on the vertical axis, we have the expected return, and as you can see my cursor, on the horizontal axis is the return risk trade-off. The diagram, in this diagram, we have a upward sloping line called AB, which is the capital market line. This basically depicts the expected return risk spectrum. That is, the representative asset classes are arrayed over a range of risk on it. As we move from government bonds here to international equity at the extreme end, the investor assumes increasing risks in the hope of earning a higher expected return. AB is upward sloping and its slope indicates the required return per unit of risk. The figure shows a positive linear relationship between the expected return and risk. The rational risk-averse investors will not willingly assume greater risk unless they expect to receive additional return, or if the investors wish to earn larger returns, they must be willing to assume greater risk. So, as you can see on this line AB, we have government bonds, then we have bank deposits, then we have corporate bonds, then the common stock, then we have the futures, then the venture capital, and at the extreme end, which is the highest return risk trade-off, is that of international equities. In this diagram, we show the required rate of return and the beta trade-off. Now, this shows the same relationship as that of my earlier diagram, but slightly differently. It basically relates the required rate of return, that is RRR, which I had explained just a few minutes ago, with the concept of beta or risk. It shows that the relationship between them, which is represented by the line DFX, which is represented by the line which is the security market line, is linear. The securities with high beta have very high RRR. The securities with betas greater than the market beta of 1 should have larger risk premium than that of the average stock, and therefore, when added to MR, they yield a larger RRR. Conversely, securities with beta less than that of the market are less risky and have RRR lower than that of the market as a whole. After analyzing the various yields and the rates of return, we now focus on a very important model called the capital asset pricing model. The capital asset pricing model, or simply the CAPM, measures the relationship between the expected return and the risk of investing in security. This model is used to analyze securities and price them given the expected rate of return and the cost of capital involved. The model takes into account the asset's sensitivity to non-diversifiable risk, that is the systematic risk which we have analyzed before, represented by beta, as well as the expected rate of return of the market and the expected return of a theoretical risk-free asset. Now, we need to look at various assumptions before we build up this model. The first assumption is we take the assumption that individuals or investors are basically risk averse, and diversification is necessary to reduce their risks. Secondly, it's a very important assumption. Here we assume that they try to maximize, the investors try to maximize the utility of terminal wealth. Now, what is the aim of an individual or an investor? He aims at maximizing the utility of his wealth rather than the wealth or return. The term utility describes the differences in the preferences of the individuals. Each increment of wealth is enjoyed less than the last, as each increment is less important in satisfying the basic needs of an individual. Thus, diminishing marginal utility is most applicable in the context of wealth. There are also other forms of utility function. Some investors shows a preference for larger risk, are those who have increasing marginal utility for wealth. In such cases, each increase in wealth prompts the individual to acquire more and more wealth. For a risk-neutral investor, each increment in wealth will be equally attractive. In other words, each increment would have the same level of utility for him. Third assumption is choice on the basis of risk and return. Investors make investment decisions on the basis of risk and return. And risk and return are measured by the variance and the mean of the portfolio returns. CAPM model assumes that the rational investors put away their diversifiable risk, namely the unsystematic risk, but only the systematic risk remains, which varies with the beta of the security. Beta we have already explained before in a separate module. Some investors use the beta only to measure the risk, while other investors use both beta and variance of returns as a source of reward. As individuals have varying perceptions towards the concept of risk and return, CAPM gives a series of efficient front lines. Fourth point is all investors have similar expectations of their risk and return. In other words, all investors' estimate of risk and return are the same. When the expectations of the investors differ, the estimates of mean and variance lead to different forecasts. As a result, there will be innumerable efficient frontiers, and the efficient portfolio of each will be different from that of the others. Varying preferences also imply that the price of an asset will be different for different investors. Fifth, quite an important assumption is identical time horizon. The CAPM is based on the assumption that all investors have identical time horizon. The core of this assumption is that the investors buy all the assets in their portfolio at one point of time and also sell them at some undefined but a common point of time in future. This assumption implies that investors form portfolios to achieve wealth at a single common terminal rate. This single common horizon enables one to construct a single period model. This assumption is highly unrealistic as investors are short-term speculators. Further, the horizon is chosen on the basis of the characteristics of an asset. So, investors have different time horizons and their estimates of stock value vary even when the estimated earnings remain constant. Instead of a single period model, investors generally adopt continuous time models as if they make a series of reinvestments. Sixth assumption, free access to all available information. One of the most important assumptions of the capital asset pricing model is that investors have free access to all the available information at practically no cost. Supposing some investors alone are able to have access to special information which is not readily available to all the investors in the market, then the markets would not be regarded as an efficient market. In other words, if the available information has not reached all, it will be difficult to draw a common efficient frontier line. Seventh point, there is a risk-free asset and there is no restriction on borrowing and lending at the risk-free rate. As a result, the investors will not concentrate on the characteristic of individual assets. By adding a portion of risk-free asset to the portfolio and borrowing the additional funds needed at a risk-free rate, the risk is either decreased or increased. Eighth assumption is there are no taxes and transaction costs are also not there. The last assumption, total availability of asset is fixed and assets are marketable and divisible. This assumption holds the view that the total asset quantity is fixed and all assets are marketable. However, models have been developed to also include unmarketable assets which are more complex than the basic CAPM that we discuss here. So, the main formula of the CAPM model is as follows. The expected rate of return should be equal to risk-free premium plus beta, that is a risk coefficient, into the market risk premium. We come to the end of this module where we talk about the limitations of the capital asset pricing model. The capital assets pricing model is the model tested under the capital market theory. This model helps the investor to build his portfolio of assets through the use of the concept of beta. Although it is theoretical, the practical applications of this is the use of market beta and individual script betas to select the scripts that are suitable to the preference of investors so that the returns are maximized for a given level of risk. Second, the CAPM has got various serious limitations in the real world, as most of the assumptions that have been mentioned are quite unrealistic. Many investors do not really diversify in a planned manner. Besides, beta coefficient is unstable. It varies from period to period depending upon the method of compilation. They may not be reflective of the true risk involved in the real world. And due to the unstable nature of beta, it may not reflect the future volatility of returns, although it is based on past history. Historical evidence of the test of betas show that they are unstable and that they are not good estimates of future risk. But the betas of a portfolio, total betas of the portfolio, may be stable. Empirical evidence have also showed that there is a positive relationship between systematic risk and the realized returns. Besides, the relationship between the risk and return is linear. So, although CAPM focuses our attention on the market related risk, total risk has been found to be more relevant and both types of risk appear to be positively related to returns. So, another limitation is that investors do not seem to follow the postulation of the CAPM model, although this does not invalidate the theory as such. The factors influencing bonds in respect of risk and return are different, and the risk of bonds is rated and is known to the investors. The conceptual nicety of the CAPM is thus broken by the less practical nature of the model and complexity and difficulty of dealing with the beta values. Lastly, the fact that betas may not reflect the total risk of the security but only the systematic risk is another serious limitation of the capital asset pricing model. Thus, in this module, we have learned about the various types of returns, yields, and ultimately the return risk trade-off in the context of a model called the capital asset pricing model. Thank you.